Uh, so what we will do is we'll go through the amendment, and I don't think so. It will take full 1 hour. We'll try to cover the amendment, how it impacts, why this amendment was brought in, what will be the consequences, and then what we can do is at after the end of the session, you can also have a Q&A, and whatever queries you have, we'll be able to solve all the queries at the end of the session as well. So maybe just taking it to what is the amendment and why this amendment has been brought in. See, the amendment is, of course, now we all are aware that today, if any foreign entity who used to earn royalty or fees for technical services from the Indian entity, they used to be taxed in India at 10% plus surcharge and cess, effectively 10.92% being the highest rate of surcharge. They were taxed in India at 10.92% on gross basis. And that was already there. Now there has been a change in that section which has happened, and where the rate has been doubled from 10.92 to 21.84. But now, that's basically the amendment, and now what will be the impact? Before going into it, let's look at what's the history of this section. If you look at it, history of this section has been, every time this section has been subject to lots and lots of changes. So if you see way back in 1976, at that time the rate was as high as 40%. Then there was some reduction in rate. At one point of time, the rate was even 25%. Then when the new government came in, the rate was reduced to 10%, stating that no, we want to do an ease of doing business. We want to ensure that the foreign companies enter into India and everything, and when they earn and pay taxes, we don't want to overburden them with high rate of taxes, and that is why the rate was reduced to 10%. Then, of course, after that, there was further amendments which were brought in on that, okay, because foreign entities, technically, there were judicial precedents which used to say that, okay, if I'm a foreign entity earning income in India, but if I'm claiming a tax treaty benefit, whether I should file my tax return in India or not. Then there was an amendment brought in a couple of years ago, that if you're paying taxes as per domestic law of India, then you don't need to file your tax return in India. Otherwise, you are supposed to file your tax return in India. So that means many of the foreign companies who are paying taxes at 10.92% were not supposed to file their tax return in India. Now what has happened is, again, there has been a tinkering of this section and change in this section, where the rate of tax has been changed from 10% to 20% again. And now, if you see, the rate has increased actually 20% effectively to 21.84, because if you include surcharge and cess. And of course, this is under the domestic law. The treaty still remains the same. So today, if you are subject to the treaty and you want to claim the treaty benefit, a non-resident still has an option to claim the treaty rate as per the treaties which India has signed with the respective countries. However, the exemption which was there, which is there under the domestic law of India, is only and only if the taxes has been paid in accordance with the domestic law of India. So if you are claiming the treaty benefit, that is lower rate, then you don't have an exemption of filing your tax return in India. So you will have to compulsorily now file your tax return in India if you are claiming treaty rate and not paying taxes in accordance with the domestic law of India. So while the option of paying tax as per the domestic law of India still exists, the only difference or the important point which is there is, you will have to now comply with the law and file your tax return in India if you want to claim the treaty benefit rate. Earlier, you had an option based, there were judicial precedents both ways. one judicial precedent says that, oh, if you want to claim the tax treaty benefit, then you need to file your tax return in India on the premise that the tax authority should have an opportunity of examining whether you are subject to the treaty or not. And other viewers know, if you are not taxable, then the question of filing tax return does not arise. And different companies were adopting different positions. And there were few companies also, what they were doing is they were paying taxes at 10.92%. That means 0.92% extra. And the foreign companies were not filing their tax return in India. And the reason was very simple, that once you file your tax return, then there'll be scrutiny, and they didn't want to. And sometimes we have seen that the tax officer, there might be litigation which could come arise, so which they didn't want to give it. And sometimes, so basically they wanted to kill the issue at source, and that is why they were not even filing the tax return by paying that 0.92% extra. Now, if I go to the next slide, which is what's the impact? Yes. So if you look at it, till 31st March 23, the rate was 10.92. Amended provision is 21.84. Now let's look at treaties which India has signed. India has signed close to almost 85-90 treaties with various countries. Some of the treaty rates, like Denmark, Italy, the rate is 20%. So you don't have any MFN clause, you don't have a particular benefit. And that is why under the domestic law or under the treaty between India and Denmark, India and Italy, the rate is 20%. So there, of course, you may want to evaluate whether you want to still go ahead and claim the treaty benefit, or you want to pay the taxes in accordance with the domestic law and then not file the tax return of the foreign entity in India. If you look at the treaty rates with US, UK, Canada, the treaty rate is 15%. Of course, under those treaty, then of course there are make available benefits, there are make available clause. And just in brief, what do you mean by make available? Basically, say a foreign company is rendering service to the Indian company, and if it then logically the Indian company say making payments to the foreign company for rendering of services. The question arises is whether it is taxable in India. Under the domestic law, yes, it clearly qualifies as fees for technical services, and that is why it's taxable. Under the treaty says that, okay, if you are rendering services which are in the nature of fees for technical services, it will be taxable in the source country, that is in India, only and only if it makes available the technical knowledge. Now, what do you mean by make available? Let's assume that, say, I'm sitting in a room where there is air conditioner, and say the air conditioner stops working, and you call an engineer. The person comes, repairs the AC, goes away. You pay their professional fees, and they go away. That is technical services. Now let's assume the same thing happens. They come, repair the AC. They also teach you that, okay, so Jimit, next time if the AC is something is wrong with the AC, this is how you repair the AC. So I'm transferring that knowledge to you so that you will not need that person again. Okay, so tomorrow if then AC goes wrong, I can repair it myself. That means that the knowledge has been transferred to me. So in those situations, the tax rate under the several treaties, and that's the concept of make available. So in those cases, if there is a concept of make available, the tax treaty rate reduces to 0% in case the services which are rendered is not made available to the Indian company. Okay, so in that case, the tax rate is 0. So if you want to claim a 0% treaty rate, then the foreign company will also have to file their tax return in India mandatorily to claim the tax treaty rate, because it is not as per the domestic law of India, it is as per the treaty rate. And that is why they will have to obtain a permanent account number in India, TRC in India, and file their tax return in India if they want to claim an exemption or benefit of the make available clause. under the India, UK, US, or Canada. There are some treaties where through MFN, that is the most favored nation clause, and now, of course, it's been subject to the Supreme Court dispute. We would not like to comment on it at this point of time because the matter is sub judice and we are awaiting the decision of the Honorable Supreme Court. So we'll wait and see. But assuming the most favored nation clause is available, there are various treaties which India has signed by which even under the FTS clause, the rate can be reduced to 0%. However, those foreign companies will have to file their tax returns in India to claim the 0% rate. Apart from these countries, there are some countries where the rate is actually just 10%, where say Germany, Singapore, Spain, Mauritius, France, Netherlands, and good amount of European countries and other countries, the tax rate is 10%. In which case, of course, there is a substantial reduction from 21.84 to 10%, which is 11.84% reduction. So practically, those companies also will be more inclined to file their tax returns in India and then claim a refund of the same. If the excess taxes has been withheld, or if taxes has been withheld by the domestic company, that is the Indian company at 10%, that they just need to be compliant with the law and they are supposed to file the tax return in India. Now the question which arises is, why will a foreign company need to file the return of income in India? The answer is very simple, because the Indian law doesn't provide any exemption and Indian law forces them to file the tax return. And sometimes some of the companies at the global level needs to give a declaration whether they are compliant with all the regulations across the world. If they are not filing the tax return in India, they cannot technically give that explanation or declaration that they are compliant with the law, because technically they are supposed to file their tax return in India. And if they do not file it, if they're claiming a tax rate of 10%, then they are in a violation of the law. So basically, there are four situations: 20%, 15, 10, or 0%. In all the cases, unless you are paying taxes as per 21.84, unless you are paying taxes of that, you will not be, you are supposed to file your tax return in India mandatorily. Now let's look at what are the consequences of this. The first is your tax residency certificate. The first thing which you need to do is, the foreign company, because they need to file their tax return in India, they need to obtain a tax residency certificate from outside India. That is the respective country. Let's assume the country from which the services are rendered is, say, Switzerland. So in those companies, the Swiss company needs to go and obtain this certificate from the Switzerland tax authority and stating that they are a tax resident of Switzerland. They will have to also file something called as Form 10F before 30th of September 2023 if they do not have a PAN. If they have a PAN, then they need to file it immediately. And they will also have to provide a no PE declaration to the Indian company. On submission of these three documents only, then and only then the Indian company can make the payment to them. If the Indian company, without taking the declaration for, which is the tax residency certificate, the Form 10F and no PE, makes the payment, then Indian company is technically in the violation of the withholding tax law, because they are supposed to obtain this and then and only then make the payments to the foreign party or book their payments and deposit the tax into the government treasury. Now, what do you mean by Form 10F? The 10F is very simple. Today, the tax residency certificate which is obtained by the global which is there, of course, as I said, the respective countries will issue the tax residency certificate, whether it's Switzerland or UK or US or whatever. Of course, they will not issue the tax residency certificate in the format what India wants. So, because India will want a particular format, none of the tax authorities are going to abide by it. So in which case, India says, fair enough. If your tax residency certificate is not in the format which India wants, I just want, say, I'm giving a hypothetical example that I want these 11 details in my tax residency certificate. So if your tax residency certificate has only 8 of those 11 details, then the balance 3 details needs to be submitted in a form called as basically form called as 10F. And now that needs to be electronically filed till 30th September 2023. So basically this 10F is to be filed along with the TRC certificate, which basically has all the balance details which is not part of TRC. Now, of course, when you are uploading your 10F, you go to the portal, income tax portal for uploading 10F. The first thing they will ask is, oh, please register yourself. And for registering yourself, you will require a permanent account number. So now mandatorily, if you want to register, which you will have to register if you want to file form 10F, you will have to obtain a permanent account number compulsorily. In the past, many foreign companies were not obtaining permanent account number also where they were receiving services, and because there was an exemption or basically a leeway available by submitting certain documents to the Indian party, where it was okay for them not to submit their or obtain a permanent account number. Now, compulsorily to file form 10F, they will have to obtain a permanent account number. After doing that, they will have to register themselves on the online portal of income tax. And of course, using a digital signature certificate, they will have to upload a form 10F. So that means, and many of the foreign companies will not have digital signature. So you'll have to also obtain a digital signature certificate and then file and upload this on the income tax portal. So now it's a mandatory thing for them to obtain a permanent account number, register and obtain a digital signature certificate. Then once you do that, and once you upload until 30th of September, you are supposed to furnish your tax return of income also. And as we discussed, the exemption of return of income is available only if you are withhold taxes per domestic law. And if you're claiming, of course, the treaty benefit, that exemption is no longer available. So you will have to file your income tax return compulsorily. And if this transaction is with your related party, then of course, you are also supposed to comply with the transfer pricing provisions and also file those transfer pricing provisions include this. Then, if you look at it from the treaty eligibility perspective, why does the income tax department want you to file the income tax return? Very simple. They want to verify that all these companies who are receiving royalty or fees for technical services, if you read the tax treaty, it says that you are eligible to the lower rate of 10% or 0% or 15% as the case may be, if the foreign company is the beneficial owner of royalty and service fees, and you are not trying to do a treaty shopping. And for verifying that treaty eligibility, you will have to compulsorily file your tax return, and then and only then the income tax authorities will be able to verify by way of scrutiny. And that is why once you file your tax of return of income in India, at the time of filing itself, it is advisable to keep those documents ready to justify that you are the beneficial owner of the dividend or beneficial owner of royalty or service fees, because that questions could arise at later point of time before the tax authorities. So it's also important for you to ensure that you have adequate substance in that entities, because otherwise the treaty benefit could be lost. Now, the question will arise is that, okay, how do I ensure that if I want to claim a 0% MFN, then can I do that? The answer is, of course, yes, you can do that. You can voluntarily do that and claim a 0%. Some of them wants to avoid litigation. You can explore a new route called as BFR, the Board for Advanced Ruling, and see if you want to claim or try that venture out. It's a comparatively a new thing. There was an earlier an advanced ruling, which was which was abolished, and a new mechanism was introduced. Right now, as we speak, only the hearings have been very recently started, but we have not seen any orders, so we don't know whether it will be uh, uh, you know, how the rulings are, whether it is favor of SSE or favor of revenue or anything. There is no trend, but that is also an option which you may want to explore. Now, the most important question, which sometimes lots and lots of clients are asking us, that Jimit, today I don't want to do compliance in India. You know, for whatever reason, once I do compliance, I'll be asked so many questions by the Indian tax authorities, which I don't want to submit, because it's not that I don't want to submit for anything else or I want to hide, but it's an additional cost to me, and the cost of doing business increases tremendously. So in which case, I don't mind paying 21. I'll take a credit of that in my home country. So I have, personally spoken to some of the countries, and some of them, majority of them has said that, see, tax credit in majority of these countries, and we need to, of course, see the domestic law of those countries. But some of the countries have stated that, see, when we give the credit of tax is available if it is in accordance with the tax treaty. Here, if you pay 21.84, which is voluntarily, which is as per the domestic law of India, and the tax treaty says 10%, in spite of that, you're paying 21.84 just to avoid compliances in India. Okay, that in those cases, those countries will possibly deny the credit of the taxes paid in India, because it is not in accordance with the tax treaties. So if it is not in accordance with the tax treaty, then there could be a double whammy, because you will pay taxes at 21.84. You may not be given a credit in that foreign country, and you will be asked to pay again the tax in that foreign country, because the taxes which you have paid in India is not in accordance with the tax treaty, but it is in voluntarily payment which you have made in India, and it's not in accordance with tax treaty. So it's a very important point to consider before any company trying to take a position that, oh, I don't want to pay taxes in India, or I would rather want to pay taxes at domestic law of India and not claim a treaty benefit just to avoid compliance. That may not be an option unless you are ready to pay higher taxes, and that will be a huge cost in those countries. Then coming, very important part is the Indian companies. We have seen lots and lots of Indian companies grossing up the taxes. Okay, so if you are grossing up the taxes, then in those costs, so for example, if you you decide that, okay, I want to gross up the tax, many a times it happens, even in case of offshore supply of goods, even in case of other cases, you say, okay, I will withhold the tax, because that's how the commercial team has gone ahead and agreed with the clients of foreign company, that foreign companies say, sorry, I don't want to do tax compliances, I don't want to pay taxes in India. Even if I have to pay taxes, you will have to pay me, say, net 100, even if there are taxes of 10, 15, you deposit it to government treasury, but net in my bank account, I need to receive 100. So in those cases, you can, of course, it's a commercial decision. The Indian company can still go ahead and sign grossing up, but they need to be careful. Now, if for grossing up also, and if you want to claim, say in India, Singapore, if you want to gross up 10%, you still have to obtain these documents from the foreign party, which is the no PE, tax residency certificate, and online 10F, for which they still have to register as PAN and everything. If you do not include this in your agreement, then the problem is that if you do not do that, you will have to gross up 21.84, which will be almost 27%. Because if these documents are not provided by the foreign company to you, instead of grossing up of 10%, you will have to gross up at 27%, which will be a huge cost to you. So you need to be extremely careful when you are entering into agreement with foreign party, and you may want to speak to your internal teams, legal team, commercial team, before agreeing on the crossing up clause and what sort of agreements or clauses you need to include, so safeguard yourself. So this is a very important part from the Indian company's perspective also, because otherwise, if they do not withhold tax, remember, it's very important. If they do not withhold tax in accordance with these provisions, there will be subject to interest penalty, and also there will be a disallowance in their hands if they do not withhold tax in accordance with these new provisions of the law, and if you do not take adequate documents. So they need to be extremely, extremely careful when they are withholding tax under these provisions, and this change has tremendous impact now. This certainly goes against the principle of ease of doing business for the foreign companies. And also because if Indian companies are bearing the taxes, their cost is also going to increase. But certainly, the foreign companies needs to be extremely careful, and their compliances in India is certainly going to increase tremendously. So with that said, so this was a very summary of what were the amended and how it impacts all the foreign companies and the Indian companies who are making royalty and FTS. We will now go to the question answers. There are certain questions which are there under the chat, and we will ask that. So one question is, pay-in rate is 10% or 20%. Application of MFN is not an issue after February 22 circular. That's exactly what I'm saying, that Spain is there, but we'll have to see how the Supreme Court interprets the issue after the circular, whether you get the MFN benefit or not. This time, many of the companies at this point of time are taking a position that, whatever they were adopting in the past, some of them are taking a position that I will go ahead and give the MFN benefit. And if Supreme Court comes against, then they will take a different position. But if not, they will go ahead and gross up at 10% if they want, or withhold tax at 10%. Some of them are taking a conservative view and saying that no, sorry, I will withhold tax at higher rate, considering the CBDT circular. After CBDT circular on MFN, whether notification is must to avail the MFN benefit. If you ask my personal view, unless it is mentioned in the treaty benefit, a notification may not be ready, may not be necessary, because that's how treaties have been interpreted in the past. Unless the treaty specifically mentioned that a notification needs to be issued, otherwise a protocol is a part of the treaty, and MFN is one of the clauses of protocol. So it generally should not be. Having said which, this matter is argued before the Supreme Court, and we do expect the Honorable Supreme Court to come out with some sort of answer in this regard. Then let's look at another Q&A. Okay, somebody has said, can you throw light from both angle, income tax and DTA? Yes, so as we discussed, under the Income Tax Act, the tax rate is now 21.84 if it is service fees or royalty. Under the DTAA, if you qualify as royalty service fee, of course, you need to see whether you qualify as that. And then if the tax rate is 10% or 20% or 15% or even 0, you can claim the benefit subject to certain compliances and documentation which is mentioned in the slide. The question is it the responsibility of the Indian company to ensure that the ITR is filed by the foreign company from which services are obtained and withholding taxes are deducted under? No, it is not the responsibility technically of the Indian company to ensure that ITR is filed by the foreign company. You can just inform them that it is your duty, and it will be a violation of law if they do not do it. But it is the prerogative of the foreign company to file the tax return in India. Your thing is to ensure that you collate all the documents in point number 1 and 2. If the foreign company is not obtaining permanent account number in India and not doing a 10F, then you cannot give the treaty benefit rate to them while withholding tax. You will have to tell them that, sorry, if you do not do this, I will withhold tax at 21.84 and not the treaty rate, unless they obtain a PAN or unless they comply and file the 10F in India, online 10F after 30th September. If they have a PAN today, that exemption is not applicable even today. The exemption till 30th September is only for those cases where there is no PAN. If you have PAN today, then they are compulsory supposed to obtain and register themselves on this portal, upload form 10F online, then only you can withhold tax accordingly. Also, in case a withholding tax is borne by the Indian company and withholding tax is paid by gross up, will the foreign company required to file the return? The answer is technically yes, they are supposed to file the tax return in India, even in case of gross up. It's only that Indian company pays the taxes, but foreign company still has to file the tax return in India technically. If the foreign company is not filing the return, whether Indian company can be considered as an agent and then proceeded accordingly. So under 163, yes, Indian company can be proceeded against if the foreign they are not able to recover the taxes from the foreign company. So as far as Indian company is concerned, what you can do is Indian company, as long as they have done the duty of withholding tax appropriately, then you can say, okay, although foreign company is not there, the foreign company indirectly has paid the taxes because you have withheld taxes appropriately and given deposit into the government treasury. Then practically, then even if they try to recover from Indian company, then the chances practically they will not be able to recover because you have already deposited the taxes. Yes, if you are giving a 0% tax or 0% make available, then technically they have the right to recover this from the Indian company if they come to a conclusion that the foreign company has not filed their tax return or paid their due taxes in India. So that technically that risk exists. Practically, we have seen very few, or in fact, except in Vodafone and very few other cases where they are going behind the Indian company and recovering this amount from the Indian company. No, practically we have not seen such instances, but technically the risk does exist. Certain foreign companies provide self-declared Form 10F and not the one downloaded from the IT website. Can we accept the same? The answer is no. You will have to actually see it has to be in the format which is prescribed by the income tax rules, and the format has to be the same. It cannot be changed anything because it's a prescribed form under the income tax law. Is only a declaration for ITR filing sufficient? What is the risk on deducted of the foreign company? We have already discussed. Japan company has no P in India and has been providing technical services. Is it taxable? If yes, how much? So if I recollect right, under the India-Japan treaty, the tax rate is 10%. So if they have been providing technical services, and if it is, I'm presuming it is taxable under domestic law, then it will be. And then under the India-Japan treaty also, it will have to pay taxes accordingly and file the tax returns in India. Should royalty and FTA be paid only in the nature of business? I didn't get your question. Somebody has asked a question, but I don't know if you can redraft. Should royalty and FTA be only in the nature of business? So that I'm not very clear on the question. Sir, can you summarize grossing up provisions once again? And as there was disturbance, okay. So what is grossing up? Say I need to make a payment to the overseas party. Okay, and the overseas party says, sorry, I'm rendering services to you. My services cost is $100. I need $100 into my bank account. Now, if the tax rate on that is say 10%, then India actually is saying that, oh, actually my payment is 111. 111 ka 10% is 11. So 11 Indian party will have to deposit into government treasury. So technically the expense for India is 111. The payment for India is 111. 11 goes to the government as taxes and 100 goes to the foreign company, and that is called as grossing up. So net 100 is received by the foreign company and 11 is deposited in the government treasury by the Indian company. That is called as grossing up. So while the payment is 100 or technically the agreement is of 100, because of grossing up, the Indian party has to bear the tax of 111. Then can we file 10F manually till 30th September? Manually is allowed only if you do not have a PAN. Then manually it is allowed till 30th September you can collect. If you have a PAN, you have to compulsory register. The foreign company is supposed to compulsory register before 30th September. And if the foreign company is not registering, the Indian party can say, sorry, I can treat you as if there is because what's the consequence of 10F? You will not get the treaty benefit because you will not enter the treaty because you are not treated as a tax resident. So then the Indian company can say, sorry, I will not give you the treaty benefit. I will withhold tax as per the domestic law of India. Okay. So if you do not have a PAN, yes, you have time till 30th September. You can obtain a PAN and then upload your 10F after obtaining a PAN. What if non-resident has obtained the PAN but has not obtained that, but no. So then it doesn't make, because without PAN, you will not be able to register yourself on 10F on the portal. So if you have not obtained a PAN, they will have to obtain a PAN, register yourself on 10F, because Without obtaining a PAN, you will not be you will not be able to register yourself on the portal for 10F. Without which it is as if you don't have a treaty benefit. Sir, is there a government notification on this change on TDS rate? No, it is part of the act only, where this change is being made. If there is a grossing up, does it need to be covered mentioned in the agreement? Yes, it's always part of the agreement. Whoever is entering into with foreign party, they always mention who bears the taxes, whether the Indian party bears the taxes or the foreign party bears the taxes. And that is always part of the agreement. So you need to look at the agreement before coming to any conclusions. I've answered all the questions. I'm looking at it whether there are any further questions. Okay. Yes, there are. Okay. If Form 10F TRC is not provided, would it affect the issuance of Form 3CB anywhere? Yes, of course. If 10F TRC is not provided, then a chartered accountant cannot issue a certificate. Especially if for two situations. If they have a PAN, if online 10F TRC not provided, then a chartered accountant cannot issue a certificate on the basis that treaty benefit is available. Chartered accountant can issue a certificate that as per if the tax rate is as the domestic law, but not as per the treaty benefit, because then chartered accountant is incorrect, because the law says you will give treaty benefit only and only if there is a TRC and 10F. If they are not able to provide, then chartered accountant cannot issue a chartered account certificate. And if tomorrow somebody complains, then the chartered accountant will be subject to liability and penalties also, because that is clearly an incorrect as per the provisions of the law. Is electronic 10F mandatory for foreign vendor even if no PAN? Yes, it is mandatory for foreign vendor. Even they will have to obtain a PAN and file 10F. Can we give treaty benefit with manual 10F? No, you cannot give the treaty benefit till manual 10F after 30th September. If you do not have a PAN, you can give the treaty benefit till 30th September. After that, foreign party will have to obtain a PAN and get an online 10F compulsorily. We consider the purpose cost code for this vendor invoice payment. However, the vendor is Israel and has also provided TRC. Do we need? Sorry, I didn't. What is the purpose code for this vendor invoice? I don't know. Vendor is Israel and has provided TRC. Do we need to deduct TDS? Yes. So vendor is in TRC and 10F has to go out. So you need to also ask that person to provide 10F. If they do not have a PAN, till 30th September, you can take a manual 10F. After 30th September, it has to be mandatorily. They will have to obtain a PAN and provide an online 10F. Else, you will have to withhold taxes per the domestic law of India. What about second condition in CBDT exempting online 10F PAN required to obtain as per Act and the rules? So the PAN exemption is available only for few people. Okay. Where there was no PAN, but foreign companies who are receiving majority, they will do it, and that is why you will have to obtain a PAN. That exemption is practically in royalty FTS very less applicable. Okay. Manual form till September is not blanket. No, it's not blanket. It's only in those cases who do not have a PAN. If you have a PAN, then technically manual 10F is not acceptable. You will have to ask them to register and then make the payment and give them the treaty benefit as a payer. I'm still now looking at other. I'm just answering all the questions. I'm reading the questions and answering that. If all the particulars are mentioned in TRE, ideally 10F is not required. But many are just following the protocols to get these documents. Yes, you're right. That if all the particulars are mentioned in TRC, ideally 10F is not required. But I am not 100% sure whether any TRC has all the documents which India government wants in a particular format. So everybody always advises to get a 10F. If there is any country which issues a 10F in the format what India wants, do let me know. It will be good to know. But what I understand is they don't issue. So yes, technically what you're saying is right, but I'm not sure how many countries issue the TRC in the format what India wants. So that is why 10F is always issued along with TRC. Filing of ITR is mandatory by non-resident if claiming treaty from effect from yes. So from financial year 23-24, non-resident will have to compulsory file the tax return in India. That means from next year onwards, 31st October 2024 and 30th November 2024, if TP is applicable, to file to claim the treaty benefit, they'll have to do that. Will manual 10F work till 30th September without PAN? Yes. Till the 20th September without PAN is okay, but after that it will not work. What will be the rate of TDS in case professional services paid to non-resident individual? So we need to see in professional services, if you want to claim the treaty benefit, first of all, for claiming a treaty benefit, you need to have a TRC and 10F, even if it's an individual. Then only you enter the treaty. Then you'll have to see whether you are eligible for royalty FTS or whether you fall under independent professional services, and then withhold taxes accordingly. Please elaborate on the requirement of applying zero deduction of tax by non-resident. So if they want to apply for a zero deduction of tax, of course, they need to obtain a PAN. And of course, if you want to do a make available, basically, if the foreigners do not make available technical knowledge to the Indian party, then the rate of tax has to be zero. There are lots and lots of judicial precedents on this, almost like 200 or more than that, 500 case laws on what's the meaning of make available. In fact, there is a full 2000-page book, written on royalty and FTS, where what do you mean by make available? So you need to look at your facts of the case and come to a conclusion that it is not taxable or taxable, and whether the make available benefit is available or not, and then come to the conclusion. Why the effective date mentioned in Finance Act is because when it's mentioned 24, it is assessment year 24-25, and that is why in the Finance Act it is mentioned as 1st April 24. So the assessment year 24-25 means financial year 23-24. Any further question? Any impact of these amendments on business income like Reddy's commission, software, or foreign company? No, not. This is only, the amendment is only for royalty and service fees, because this was 10% gross. They have made it to 20% gross. Any further questions? I don't have the notification details for 10F. See, it's part of the law, and on 1st of April only there was a notification issued, because they had made it from 1st of April, and then they issued that it is impossible for those cases to obtain 10F immediately, and that is why they relaxed it. So you can look at the notification on 1st of April, you will get from the income tax website. Next. Any further question? Will software subscription be subject to TDS under 195 like Adobe and LinkedIn Pay? So software, so that's a topic issue, whether software subscription is subject to question. First you need to see is whether it is royalty or FTS. There has been a Supreme Court decision last year. You need to see based on that whether it is royalty or FTS. If it is not royalty FTS, then of course the question is, because technically that was also in accordance with the tax treaty, then you of course need to comply with this law and then come to a conclusion that it is not royalty FTS, but the other party will still have to comply with the Indian law and file their tax return in India and obtain PAN and 10F as well. There is the provision for filing of 10F manually in case of earlier years before financial year at tax rate. So it was not filing of 10F. You need to obtain, as an Indian party, you are supposed to obtain a 10F mandatorily, because 10F is I would say, an ancillary to TRC. When the amendment was, TRC was there. So at that time only 10F had to be obtained, because they wanted TRC to be in a particular format, and they mentioned that if TRC is not in a particular format, then 10F needs to be obtained. So today, practically all the Indian parties, before making a payment, or ideally all the chartered accountants before issuing 15 CSEB, has to take 10F also for their safety also. Payment of fees could be in the course of business or could be for other reasons. Yes, it could be for any other reasons. You need to check whether it qualifies as royalty or service fees under the treaty, under the domestic law, and then apply the provisions accordingly. Just looking whether there are further questions. Questions are keeping on adding, so. Okay. I believe there are no more questions. What is MFN clause? MFN is called as most favored nation clause. So you will not find, if you do a control F, you will not find something as most favored nation in protocol. It basically, there is a particular clause that if after the signing of this treaty, if the same country signs a treaty with another country which gives a beneficial rate, then it should even be applicable to me. So it's because what's the logic of MFN is like, say you will not sign treaties again and again. Say you are signing a treaty with France and say, okay, I will give you a concessional rate of 5%. And after that, you are signing a treaty with Switzerland. Okay, you are signing a treaty with France and say, okay, I will give you rate maximum is 10%. India will withhold. Okay, India will retain. And France says, okay, but after signing of this 10%, if you give better rate to any other country, which is say European country, okay, which is basically an OECD country, you give a better rate than 10%, then you should give it that rate to me also, because otherwise it will be unfair on the France residents. So then that is what is called as the MFN, that you are also giving the most favored nation clause, that of Switzerland, to also France. And that is why if you are giving concessional rate of 5% to Switzerland, that will also be given to the France, and that is was the concept of most favored nation clause. From where can we check the date of signing of the treaty? The treaty itself has the signing of the treaty date. You will come to know the notification and everything. Subscription paid by the employees through credit card form 15 CSC. Yes, that's another issue of 15 CACB. You need to be very careful when software subscription is made. There are different issues which will come up on royalty FTS and also the equalization levy. You need to be careful when you're making, when employees make the payment through credit card. You need to be extremely careful. Ideally, that's not the right way, because otherwise you will keep on violating the withholding tax provisions. All the non-resident are required to obtain PAN who provides royalty FTS. Yes, if they are claiming the treaty benefit. If they do not claim the treaty benefit, they are okay with 21.84. They are okay if the treaty benefit is denied in their foreign country, which they can check with their foreign consultants. Then yes, they are not supposed to obtain PAN or do it. But if they want to claim the treaty benefit rate, then yes, they will have to obtain a PAN compulsorily and file 10F. Okay, somebody is asking, please explain grossing up indicator. Okay, I'll just simple thing. Say I need to make to you a payment. You are a non-resident. I need to make a payment to you. I've taken certain services from you and say $100 I need to give the payment. You will say, sorry, oh, I am a non-resident. I don't want to bear or any taxes in India. You please pay me $100. $100 has to hit my account. If there are any taxes which are paid in India, Jimit, you have to pay or you have to bear. I don't care whether it is 10%, 15%, 20%, 30%. So, as an Indian party, but I have to, because I am a payer, I have to be compliant with the Indian law. So, if suppose that payment is subject to TDS, I will have to pay from my own pocket and deposit that into the government treasury. And that is called as the concept of grossing up. That you gross up that amount so that government doesn't lose out and you pay the taxes into the government treasury and the foreign party still receives the $100 into the bank. CBDT circular, I don't recollect the circular immediately on this phase, but it has been very recently on the MFN somewhere around February. That's where we need to do it. So in gross up return to be filed in India, technically the answer is yes. Gross up technically they have to file the tax return in India. Payments for cloud storage, whether it is royalty FTS, if you ask me, we need to take 2-3 hour session of as to what do you mean by royalty on FTS on payments of cloud storage. It's not an easy answer. We need to actually have a separate session. But if you go into that, will take 2-3 hours. So at this point of time, I may not be able to answer that because it's not just a plain yes or no. We'll have to look into various factors before we come to any conclusion. Which provision have to be read? 115 BA you need to read the provision. Is there any impact of MLI? No, there is no impact of MLI. This is directly a law, amendment law in the domestic law. Treaty is same, so there is no impact of MLI. Subscription fee paid outside India, whether royalty payment or business. I don't want to comment. You will have to see the respective treaty. You will have to see whether it qualifies as royalty under those treaties. Then you will have to come. You may also just want to check if it is not royalty FTS. You may also want to check the equalization levy implication for that subscription fee, possibly because you are writing online force. So if it's not royalty FTS, it could be covered under equalization levy also. I think so. We are at the end of our. I thought it was good 30 minutes discussion and 30 minutes question answer. I think so. I was able to answer more than, I don't know, 45 questions. But we have last 1 minute before anybody has any question. I will be happy to answer those as well. I've answered all the questions which are there on the slide, but when EL is applicable, there is no requirement for 10F. Technically, when EL is applicable, there is no requirement for 10F. But remember, EL is applicable, EL will go into the second stage. First, you need to check whether royalty FTS is applicable. If royalty FTS is applicable, then 10% has to be withheld compulsorily, because EL is 2% and royalty FTS is 10%. So if it is not royalty FTS, then only EL. And for EL, you don't take a treaty benefit, and that is why there is no requirement of 10F. I think so. We are done with all the questions. Unless I miss. Sorry, somebody is asking. Wait. Which treaty to consider is. I'm just trying to answer those. Why the grossing of payment is done by Indian company instead of foreign company? Because it's a commercial thing that foreigners, typically it's a commercial thing. Foreigners will say, see, if you want my services, they are in a bargaining power. I don't mind rendering you services, but I need my full payment. I don't want I don't want to pay any taxes in India. If there is any taxes in India, the Indian company will have to bear. And commercially, Indian company, because they are in need of those services, because maybe there is monopoly, they agree to such clauses in the agreement. Which treaty to consider is payment is to one country towards reimbursement for services provided by another treaty country. So this is triangular situation, but remember, always you need to check which treaty will have to do. There will be a situation of triangular cases depending on which country you see. Remember, in case of reimbursement also, royalty FTS provisions are up. If it is, while many of them say it's pure reimbursement, it may not be a pure reimbursement. You need to see if the original payment was subject to royalty FTS, even the reimbursement could be subject to royalty FTS. In case of grossing up, why? That's a view. Now, many of the foreign companies may not want to file their tax return. It's just a view that whether they need to file the return of income. Shield Thakur, 1 minute, please. Okay. From where we can check that any beneficial rate available with other treaty and we can claim that rate for MFN? You will have to technically analyze all the tax treaties of 89 and then you will come to a conclusion whether there is an MFN clause or not before looking at the treaty. So if you get more understanding of the law, there are books available where you will get this. You can take a BCA also. There was a book which was published. You will come to know from there, Bombay Chartered Accountants Society. There could be books also where you can find a thing. More often than not, we come to know a good amount of European countries based on experience where the MFN clauses are there. Like I know Netherlands is there, Spain is there. There are MFN clause. Germany doesn't have. Singapore has. US has. So various clauses, they do have MFN clauses. So you need to take. So US doesn't have, but US has a make available clause. For gross sum, it is approved by the payer management, but the same is not in the formal agreement with the payee. So if it is not in the formal agreement of pay, then you need to agree on email that okay, you are grossing up the taxes, but that needs to be deposited into the government treasury. Okay, I think so. I've answered all. I'm just looking if there are more. I don't know. Please repeat last sentence other than royalty FTS. I didn't get the question. How to check non-resident is beneficial owner? Again, a long topic, but just very simple. It's like this. If you are a beneficial owner, simple thing, you should be able to enjoy with whatever you have received. So if say for example, if you are receiving dividends and on the same day you are passing it to somebody else, there are instructions that whatever gets credited to your account needs to be passed on to the topmost person. That means you don't have the right to do with the money whatever you want. If it's your money, you can do whatever you want, right? With that money. If you are able to enjoy that income in the manner in which you want, that is called as that you are the beneficial owner. If you are restrictions that you need to utilize this money only for this purpose or you need to pay it back, then technically you are not the beneficial owner. If somebody else is deciding for you, that you cannot be the beneficial owner. Whether business income taxable in case of no PE and how to bifurcate whether it is FTS. Yes, it's a big topic. You need to first always look at it. What do you mean by business income? You always check when you apply. There is a royalty and FTS first you need to see. You need to also see business, and there is a mechanism. How do you come to a conclusion? Very difficult to explain in 1 minute, but that's a good question. But a detailed thing needs to be discussed. To answer this question will take half an hour. So, but net you will have to see an FTS clause first also and see whether it is taxable as FTS because it's specific, and then you go into business. In case of IC sale agreement, what we will have to take there. Technically, no, but many of the Indian entities on a conservative basis are asking for IC sale agreement also. They are asking for this 10F compliance. There are two views on the same. That does not have a clear-cut answer because it's not a royalty on FTS. It's a supply of goods. It's not covered under this royalty FTS, and that is why you don't have to take the documents because of this amendment. There was another amendment of SCP 1.5 years ago. Due to that, you may have to take certain agreement for IC sale, not due to this amendment. Whether business income in case no P and how to bifurcate, I think so Isha has raised the same question. I've answered that. I think so I've answered all the questions. If the payment is less than 10 crores, still rate is no. If the payment is less than 10 crores, you need to apply the surcharge and cess effectively, accordingly. In case it is not FTS and business, then there is a tax rate available. If it is not FTS and business income, then tax rate is no. Then if it is no PE, no tax. If it is a business income and if you do not have a PE, it is not taxable. And if it is a business income, if you have a PE, it is taxable as per the domestic law of India, which is 40% on net basis, plus surcharge and cess. So effectively 43%.